let's get underway. We'll get underway with our February 10th, 2026 edition of Bull Sessions. My name is Mark Robertson. I am founder and managing partner of Manifest Investing. We've been doing this for 21 years, believe it or else. I'm joined here by that magical, magnificent mathematician from mid-Michigan, Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. Good afternoon, everybody. I'm celebrating sunlight and 40 degrees here in the mid-Michigan area, just south of Saginaw Bay. I get a number of questions asking, where in the heck is mid-Michigan? It's midway between up north and Detroit. So that's where the name came from originally, I kind of gather.
Mm-hmm.
And it includes the area around Saginaw Bay and upwards on Lake Huron. We only border one of the Great Lakes in mid-Michigan. That's Lake Huron, although the mid-Michigan chapter now borders lots of Great Lakes because we
all of the above.
Not all of them, but lots of them.
Three of them border Michigan.
Well, actually, there's 4 Great Lakes that border Michigan, but we do not touch Lake Erie. So,
all right. So we are joined also by Kim Butcher she just came in from the swimming pool down in Southern Florida. Good afternoon, Kim.
No, Kim has left.
She went for a chocolate break, probably. We will probably talk a little bit about our Ardelyx as we close here today. And Matt Spielman is with us.
I'm here, just coming out working from my garage. It's getting to be too hot to work outside in the garage.
Oh, gosh. Kerpel, and Kerpel, if I'm butchering your first name, I apologize. Kerpel wants to know, Mark, because I know you follow SPRY. Any comment on why the growth has moved to 0 in that company?
I'd have to look closer. Could be an anomaly in the data. I don't.
Well, he's drawing your attention to the fact that the growth on the Manifest site is showing 0 at the moment, and I think he wants to know if that's a real 0 or if we have a bug somewhere in the system for that stock.
Unless they have sharply curtailed their forward-looking forecasts, that doesn't sound right, and I don't believe they have. So I will take a look, and I'll post a correction if it's needed.
I've got some questions too, Mark. AstraZeneca has been doing some odd things with delisting themselves on one exchange and moving to another exchange and trading and changing the way they issue shares in the U.S. And I think that you have to do a nice review of AstraZeneca to make sure that all the numbers have stayed the same during all their ups and downs and machinations with the market here. So I've gotten a number of people asking me about AZN.
Ken, I want to thank you for that sugarcoating. Yeah, a lot of the non-U.S. companies, the international companies, are going through something. And it's just one of those, it's always something, or it's just another one of those things. Because I'll tell you what, as we get caught up on a bunch of other stuff, that does look like a new challenge that needs to be faced. I ran into it on at least a half dozen other international companies where I think they're substituting their own currency instead of dollars in their reporting. And I don't know the answer to that yet, but that alone is enough to really cause incredible disruptions.
Well, we noticed it in AstraZeneca when I was helping my sister rebalance her portfolios this weekend, Mark. And there is a nice press release from AstraZeneca itself telling you what they did. And it did affect some of their values and everything. So you might want to take a look at it and see what you can figure out. Maybe the data sources haven't caught up. It just happened late last week. Whatever they did just occurred. So Gerald wants to know, when's he going to be able to get the full Groundhog list for 2026?
It should be out today or tomorrow. So we're going to push the button and hope that we don't blow the whole thing up. But That is the plan right now.
Okay, real good.
So yeah, that's the reference at the bottom. The number 19 is and ended, and we are beginning 20, and 20 should be out hopefully tonight. I did sneak in a couple entries for myself and a few others, right under the wire. And again, as we already made clear, don't be shocked if I'm not number one when we turn it on. Had a little unofficial help.
And let's repeat what we said before the program started, Mark. If you've somehow neglected to get your entry into the Groundhog contest and would like to be part of the madness, Mark is still taking submissions. If you get it to him sometime in the next hour and a half or so, he'll add you to the list. The creating of the portfolios is really the easiest part of this whole thing right now, isn't it, Mark?
It actually is. And I will warn you that if you send in a portfolio where every single one of your 5 selections has gone up 20%, we would have questions.
Well,
and we actually have a list. You'll actually see the list. My rogue monkeys in the conference room gave me a list of the companies that have gone up a bunch. So I use that for my shopping.
You could ask to see the January dated SSG that led you to that conclusion.
There you go.
So, I think he's kidding, folks. Give him one where they've all gone up 40%, and he'll take it, because our experience is that they ride down the roller coaster just as quickly as they ride up the roller coaster. Those kind of stocks. So.
All right. So yeah, there is a bunch going on. We will take a look at the international issue, and it will go away in just a matter of time. I did point out to Ken that AstraZeneca should be working on buying Ardelyx and nothing else right now. Yeah, Starbucks is in this week's issue. It's being mentioned by a number of people. Domino's is also in there. Congratulations to the Seattle Seahawks for their Super Bowl 60 championship this weekend. And again, it was a fairly decent year for some commercials. I do want to brag a little bit. The commercial, which has been cited as perhaps one of the 25 best Super Bowl commercials of all time, was the Lay's potato commercial. Did you see that one, Ken?
Mark, you know that I don't follow this kind of stuff, so I'm in the. I still think that one with is it Joe Green or what's his name? Joe Green.
That's Mean Joe Green with the Coca-Cola.
I think that's probably the best one still. So that's
it's in the
current as I am. Okay,
it's in the top 3. Yeah, the Career Builder Monkeys are definitely in there. But no, the Lay's potato commercial is it's a kind of a documentary style commercial of a father giving the potato farm to his daughter. And the really interesting thing is I come from a very tiny town in northwestern Illinois, and the potato farm is across the highway from my parents' house. The one that's actually featured in that commercial for the Super Bowl was right across from my parents' house in tiny Savannah, Illinois.
Are you asking me to go out and find a trophy for that, or what are you?
Well, I'm just telling you, it's really kind of cool when you come from this fairly obscure place and something like that happens to you. Anyhow, all right.
I'm kind of laughing in the background because I have a note here from one of our participants, and Nick is wanting to know, can you determine whether any of the Groundhog entries are generated by AI, and if so, what are you going to do with them? And Nick, if you've played around with any of the AI engines, Mark and I have, they don't appear to be really good stock pickers. I'm fully in favor of identifying a couple of portfolios that were generated by AI and let them play in the contest this year. Let's see how they do.
Well, Ty Hughes has already done that, and he's full disclosure. He tells us, where they came from and how, and so they're in there competing.
Great. So we'll see at the end of the year if there's anything to their stock picking abilities. I have to remind myself that anything AI does is based on something that some human has done somewhere at some point, and that means that they get a lot of conflicting evidence about whether stocks are good buys or terrible buys at any particular moment in time, because there's no consensus on any of this stuff anywhere.
I tried to.
I saw. I'll have to see if I can find it. One of the most interesting, and it was very brief, commentaries on AI and the AI threat to software companies. Basically, seeing AI as the opposite end of, let's say, traditional deterministic computers and computer software. And kind of your point, Ken, the closing line I remember was very good. You would no more want an AI to define your budget for next year than you would design your next marketing campaign with Microsoft Excel. As a way to illustrate that maybe we're talking about a hammer and a screwdriver, not which is the better hammer.
Well, that's it. Thanks, Matt. That sets me back.
I is making the point, Mark, in the questions here, that Moose Pond GPT from last year's contest was a completely generated AI portfolio, and it finished number 33. So it didn't do all that badly, but it certainly didn't vie for any of the championship spots either. So
I will tell you that I tried to get Manifest Investing to do my picks for me using the embedded AI that you guys will all hear more about here fairly soon. And the answer I got back, I'm sorry, I can't do that for you, Dave.
Dave, all right.
So
I think that's Kurt defending his method.
Yep. And it was. It literally it said, we don't do that here. So we'll see. Now I could probably change the words and get around it, but we'll see. All right.
Well, let's get going on some slides with some actual investing stuff on them, Mark. Here we go. Okay?
This is actually still about investing, Ken. We want to remind that it is traditionally that month when you reach out to somebody that you care about, a friend or family member, and try to get them involved in some way. And we also celebrate all of you that have been with us for so long with a special legacy discount that's good through the rest of February. So let's go ahead and honor Ken's request to get onto the really important stuff, and that would be hot dogs. Portillo's is back at a pretty good price again.
My goodness, we have Portillo's, and we're back to Ichimoku as well.
Yeah, we could do some relish on there.
What goes around comes around. Okay, keep on a moving.
And okay, now the thing, the tweet at the left points out that if you had invested in just hot dogs, look how well you could have done versus the NASDAQ.
You mean if you bought it when it was down at $4 a share? Is that what you're talking about now?
Yeah, there's Nathan's. Nathan's actually went up like 600%. I'm ready for Portillo's to do the same.
You're missing a zero. It's 5,600% in 25 years, 23 years.
And you know, the Motley Fool actually featured that company like 10 years ago, and I just kept scratching my head.
I hear hot dogs are not threatened by AI either.
All right, the two of you are
moving on. Moving on before we lose control, celebrating the Groundhogs. No investment recommendation is intended. This is entirely about education. It is truly a demonstration. We love demonstration. We basically are here to share the stuff that we have observed, learned, exploited, deployed, the lessons of the modern investment club movement with respect to discovering opportunities and putting them to work for you, and hopefully making it so you can sip umbrella drinks sitting on the bay somewhere comfortably at some point in your life, or who knows, build a library. Ken and I have a friend who one morning woke up and decided to build a library for Bowling Green University. These are all good things, but we're not your boss. Please make your own decisions. And if you need copies of these slides, or if you have follow-up questions or suggestions, let us know and we will tackle them. You're going to witness a couple of those here as we go forward. Anything else, Ken?
No, I love some of the new pictures that are across the top there, Mark. Those are, I really like the third one in. He looks sort of like one of us. Okay.
Pensive. That's the pensive groundhog. All right. Here's our characterization of the market. Again, just to put into context, you know, what should we expect from the quote, I'm doing air quotes, Ken, the average stock out there? And the answer to that is 8 or 9%. What are your thoughts on here?
Well, I'm not as happy with my par kind of moving away from some of the value line numbers, but at the same time, I still think it's close enough that I don't have to worry. I do note that in history, that blue line occasionally does move quite a ways away from that gold line. And so it's not uncommon, it's not unheard of. And they're still in a nice 8 to 10, 8 to 11% range over time. So that's average, and that's where we are kind of. Notice, folks, that green bar, the light green bar at the very far right of all the bars is sitting well above the line of reasonable expectations right now, which suggests the market is overvalued right now rather than undervalued right now.
Yep, and anytime that peaks up there, it generally gives the talking heads the heebie-jeebies. Most of them will be talking about apocalypse this afternoon. All right, pressing on. Here are our performance perspectives. Again, for most of these entries, we're looking back 10 years, so it's a 10-year perspective. And the company names are the 10 most widely followed companies by our subscribers. And the kind of neat thing here is two things. We demonstrate that, first of all, I own 6 out of 7 of those top 7. I think you own quite a few of them also, Ken.
The top 7, I own 7 out of 7 on the top 7, yeah.
I'm still trying to figure out how I missed Fastenal along the way, but I did. We did. I'm blaming my wife for that. But the rest of them, yeah, we have owned them or currently own them. Microsoft is our largest holding in our family portfolio. So that just proves that it can be done. We also prove that it can be done with a demonstration portfolio that invests just like Walter Schloss. If you've never heard of Walter Schloss, Google SCHLOSS and be prepared to go on a learning adventure. He invests just like we do, and he's one of Warren Buffett's best friends, or was. The Investing Roundtable is our monthly collaboration. We typically do it the last Tuesday of every month, and we'll have a little bit more on that coming up, but that is literally friends coming together, sharing discoveries, and taking care of a tracking portfolio that's done pretty well over the years. The indices that you see represented there, most of those are investable in some way, and they tend to huddle and they cluster right around that 10, 11, or 12% range, which is really cool. It beats the heck out of stuffing mattresses, but we like the numbers at the top better. We find those by sharing ideas with our friends. That's how we discover those over time. And last but not least, Ken, you have to be pleased that Buttonwood has notched up again.
Well, I like it sitting above Cognizant right now, and I know that our benchmark is quite aggressive for the short period of time that Buttonwood's been in existence, but I'm kind of watching the total return column, and I think we need to take down the mid cap now with our return. So that's my next very short-term goal. I want to see that Buttonwood total return surpass the mid cap total return on the way to moving for 5 years. I want to see where Buttonwood is at the end of 5 years. So far, we've just passed our 2-year anniversary for the portfolio.
And you know, chasing that mid cap might actually be a bit challenging, much like the Budweiser Clydesdales. We're going to do a mini Super Bowl commercial here. The Clydesdales taught an eagle how to fly during the Super Bowl, and the mid caps have been beat up for so long, along with the smaller companies, that they probably have better days ahead of them. So those Budweiser workhorses ought to be that image for those mid-cap companies.
Well, and I'm suggesting that's a very short-term goal. I'm still kind of aiming at the Wilshire 5000. I would love to match the Wilshire 5000 in the next year and a half or so, and then move above that. So that's That's the long-term goal for a portfolio like this, to beat the market. And right now, with our benchmark at more than 20%, that's a race that's proving exhausting some weeks, I'll tell you.
I still like 9.6 better than minus 0.6. So
absolutely.
All right, gentlemen, there's your reminder. You have about 5 days to take care of your Valentine's Day preparations.
Well, you learned early that it was coming up, Mark, so you should have no excuses, all right?
I just missed by a day or two. It's actually 4 days from now, I think.
I will share with our audience that Mark wanted to slap a workshop right on the top of Valentine's Day, and we pulled him off the roof on that one. So
got to keep me out of trouble. All right, here's a quick look at our best small companies that we pick on Halloween. How are they doing a few months into the run? And they're doing okay. And they're beating the market by 2.6. We're not going to dwell on that too much because Ken is quite superstitious. But pretty good performance top to bottom. I will
now,
say...
Where'd you get the 2.6? I'm reading 6.8, Mark.
Oh, I'm wrong. Well, the 2.6 is the actual market return. We're beating
there we
by
go.
6.8.
Yeah.
Well, thank you. That actually brightened my day.
I certainly did. But when I saw this, I was extremely happy to notice a relative return. And remember, this is very short term. This is just dating back to November 1st, 2025. But in that 3-month period, we're beating the market by almost 7 points now in the aggregate, in the average of these 20 companies. So
I have a lot of faith that Vital Farms is okay. I have a lot of faith that if you don't like the price of iron down here at the bottom, it's much like the Michigan weather. When you get up tomorrow, it will be 5 or 10% different. It's one of those. It's related to those power generation companies.
It was quite an outlier a month ago, Mark, at the very bottom of the list, and it's now moved back into at least the range, the reasonable range, in that whole group at the bottom now. So yep. It's no longer just sitting all by itself at the bottom. So
yep, so good stuff. I mean, pretty good.
I'm looking at those guys that picked Oddity, and I'm saying to myself, that's a good selection group for Oddity Tech. Okay.
Oh, are you ever asking for it?
I know.
Yeah, somebody mentioned about SPRY. I can't even explain why there's not a number there. So we'll fix that. All right. I thought we'd tackle this question a little bit. This is a question that's come up 2 or 3 times. This one came from Frustrated in Arizona, basically talking about how he or she is irritated and annoyed that every time that they recommend a stock to their club, they seem to go down for the next few months. And I think many of us here can relate to that. There does seem to be a real curse on us sometimes. I mean, witness the early performance of Buttonwood. Ken and I would sit around and scratch our heads saying we don't deserve this. And it just does happen. But what we kind of wanted to draw your attention to, did you want to add to that, Ken?
No. Nope.
Okay. Basically, the person asking the question is talking about the quality checklist that's in the Stock Selection Guide handbook. And I don't know. I think we do it better, and that's all I'm going to say. When we look at quality at Manifest Investing, we are basically looking for companies with better growth forecasts, better profitability, more stable profitability, a strong balance sheet. We take a better look at the capital structure of the company. We pay attention to what they pay for an effective interest rate and how much debt they actually have. You can't do this. If you're an experienced investor, you can't pick a number like that because it's very industry specific. That number down there is intended to protect a beginner, going with the theory that if you help beginners avoid companies with debt, you can help them avoid bankruptcy. Well, I can prove to you that that's not always true because I've actually experienced bankruptcy with a company with 0% long-term debt. So, but that's what that's for, that 33% number.
Well, I think the whole concept of a chart like this, Mark, needs to be understood in the context of about how it was prepared, and the whole context of the chart is to help beginners. It's to give them some guardrails when they're just starting out in investing. But just like training wheels, at some point you have to discard some of those training wheels, and you have to start being a little bit more aware of what actually happens. That last line under debt, for example, that says consider industry averages, becomes more and more important as you understand that certain industries carry a lot more debt. When you begin to understand that the debt numbers include leases, that really muddles up the debt. When you're looking at the return on equity paragraph here, which is 3 boxes up from the bottom, you need to understand that debt and return on equity are kind of joined at the hip because of the arithmetic used to calculate return on equity. And companies with really high debt, many times that debt has pushed return on equity up. That seems counterintuitive, but that's what happens with the arithmetic. So when a company has real high debt, return on equity numbers are not nearly as useful, something to tell you whether you have a high quality company. You go up to the 4th box down, that's the one that says small, medium, and large up there in this thing. And those numbers for the characterization by those 3 adjectives are dependent on inflation. In my investing career, folks, with Better Investing, which covers about 33 years now, those numbers have been readjusted 3 times because of inflation. And they probably are in need of being readjusted again because of the recent inflation that we've encountered. Mark and I talk to you constantly about small companies, and we've readjusted our guidelines for a small company to be somewhere in the 3.5 billion area, all the way up to that amount in sales we've decided is probably small in today's market.
Yep.
And we think that if you're going to characterize a large company just as needing 10 billion or more, you're probably making that group much larger than it should be. I'm not gonna hazard a guess as to where I think large begins, but I don't think it begins at 10 billion anymore.
Yep.
I think probably 50 or 100 is probably a much more realistic number in today's realm of mega cap stocks. And maybe we even need a 4th category to include those, those above 500 billion or those above 750 billion, something like that, because they certainly don't act like a large company. Many of those companies that we're talking about, the Nvidias and Metas and Googles of the world, they're not acting in a 5% growth rate arena anymore. So these rules are not rules. These are just guidelines for beginners. And as you get more experience, you become more nuanced. And I think then you begin to look at some of the things that Manifest uses to give a quality rating. And you have a little bit more faith in quality when it's scaled on a percentile, so that you can see which companies are moving to the top of the quality rankings and which of those languish in the bottom 30 or 40% of the quality ratings.
Yeah, so this is a long
I will descend from the soapbox, Mark.
Yeah,
okay.
Well, we hate to beat up too much, but keep in mind they are decent things to think about, especially for a beginner. But you very quickly want to move to context. The other thing I would share is this quarterly nonsense. Be careful with quarterly stuff. I mean, making too many judgments about quarterly, and you really ought to be paying more attention to this word and how that compares going forward. And we need to spend plenty of time doing that. in a nutshell, if you want more on this subject, if you go to Manifest Investing or just simply go to Google Manifest Investing and the word excellence, we explain how we look at this stuff. And it's not our definitions. It actually happens to be the definition promulgated by George Nicholson, founder of the organization, and Benjamin Graham. So that's where they come from. Now, with respect to the question, we share your pain. A friend of ours told us many years ago that when it comes to the rule of five, if you pick 5 stocks, one of them will do what you think it's going to do, or one of them will exceed your expectations, 3 will match them, and 1 will greatly disappoint you. You can never predict which one of the 5. Now, he insisted that he could just avoid purchasing the 5th in that rule of 5. So if you can do that, you can do extremely well in investing. But yeah, there's nothing you can do to prevent being unlucky. You can do the best study in the history of investing. I've done that a few times for the roundtable and been disappointed. So yeah, there's nothing you can do. So you just have to learn to grit your teeth a little bit. One tool that we think offers a little bit of promise, and we are not technicians. We are not price chart driven investors in any way, shape, or form. But this relative strength index does have some strength or potential, I should say, for identifying entry and exit opportunities. And it should be treated as a nudge to study and think. And if you want more on this, you go to stockcharts.com. You can actually go to this whole link and go through an article, but we actually use it. We actually use this as, I've actually used it as a tiebreaker. If I got 2 companies that I really like and I'm considering purchase, the RSI, this relative strength index, might serve as a tiebreaker for me.
If you listen to very carefully what Mark just said, he's using it as a piece of information that occasionally gives him good guidance and occasionally doesn't give him any guidance at all.
Mm-hmm.
And I think that's the mistake that's being made by a lot of, let's call them just past beginners or maybe intermediates, or I like to just talk about the amount of experience and the amount of nuance that you're able to bring to your investing. And anybody that's setting hard and fast rules for anything in investing is probably setting themselves up for some disappointment. And so if you're telling me that you always would buy at an RSI here and you always would sell at an RSI there, that's not what Mark is talking about. Mm-hmm. He's talking about a piece of information that might help with some guidance as to what you might want to do, and especially in tight situations. He mentioned a tie, I think, mm-hmm. or two stocks that you're considering. It might be enough to sway the balance one way or the other when they're tied, but don't misconstrue anything that we're saying as rules, because there are no hard and fast rules in investing, except maybe the one I just said. There are no rules. There's a rule for you.
All right. Well, Ken just said disappointments. Well, here is, this was actually presented by Barry Ritholtz and Ben Carlson as companies that have currently or recently run into an iceberg. And they're obviously talking about the Titanic versus the iceberg. We all know who won that contest. There's a bunch of companies that are down fairly significantly from their highs, or, just from literally from a few months ago. And there's some pretty staunch community names on that list. So for a little bit of fun with dashboards, I threw them on a dashboard. And I entitled it Iceberg versus the Titanics. And what I wanted to show in answer to that question that was asked just a little while back by the frustrated in Arizona, this is what I turn to try to give me an edge. There's no promises here. There's no guarantees, but sometimes you can get an edge. So here are the companies on that list. They are sorted from lowest RSI, which would be companies that are potentially oversold, could be buying opportunities, down to much weaker buying opportunities at the bottom. All of these companies up at the top have considerable, formidable strength in terms of long-term expectations and quality. We also know that in general, if you buy double-digit growth, sometimes that will help you with the challenge. Sometimes that corrects all errors. But more importantly, you're talking about a group of companies that are potentially beat up and oversold. And Hugh McManus has taught us that you can also pay attention to the companies that are fairly close to their 52-week low, and you see a number of companies here that are attractive. So if you said, Mark, you have to go shopping and you have to go shopping among these Titanics, I can find a couple companies here interesting. How about you, Ken?
Absolutely. I think one thing that is important, and we'll start to emphasize it more and more since we have better graphs to look at. But I think that not only is the value of that quality number that Mark pointed out important, but I think the value of the quality in the last 4 or 5 years is also very important.
Mm-hmm.
I'm looking at the stock right beneath that big box that you drew on the right-hand side of the graph, Mark. I'm looking at United Health, and I know that when I used to own United Health, I was not owning a stock with a quality around 50%. And I know that in the last 3 or 4 years, the quality has shown a lot of decline from the places where I used to own the stock and I was happy with its quality. So that kind of stuff is very, very important, not just the number, but where has that number been recently? And a declining quality, especially a significantly declining quality, can be a big red flag for any particular stock that you might want to take a look at. I really am looking very carefully for my own portfolio at 2 stocks in the 4 that Mark identified. I'm looking at Adobe and Netflix myself for possible inclusion in my personal portfolios. I do not own either one of them, but I need one more stock for one of my personal portfolios, and these 2 are on my short list of 5 or 6 stocks right now that I'm putting through the meat grinder.
All right, so one last thing. If you go and you can create this dashboard and have some fun with it yourself, fun with dashboards. I put $100 in each one so that I could create those averages at the bottom. You can do that by entering all the tickers and just assigning $100 to each one. But the other thing I want to bring your attention to is these 2 columns I added. In fact, I added the prove also and the core score. So these were all added to the original dashboard. You do that under actions. So under actions, I got rid of the price and the value and all that kind of stuff. And got rid of the percent yield. I wanted to focus on these 4 in addition to the other columns. So under actions, you can customize and edit your dashboards. Play with that. Have some fun. A week from this coming Saturday, so not Valentine's Day, but Valentine's Day plus 7, Kurt's going to actually run a workshop where this is among the things he will demonstrate, how to customize and change this dashboard to the way you want it.
Mark, when we did our Jamboree last Saturday and looked at portfolios from all across the country, I captured portfolios with proven core score. I added that to the thing. Mm-hmm. That was the most asked question in my emails in the next week since the Jamboree. Mm-hmm. Is how did I do that? And I want to tell people that when you press the actions button, the first thing that comes up, and it's in a black type. It's not in a blue type like a lot of the rest of the things on the list. But the first thing that comes up is the word columns. And that's where you press to either add or delete columns from your display.
Yep, so have some fun with it. And if you have questions, ask away on the forum. And Kurt will direct, and he will actually demonstrate at that Saturday morning session couple weeks from now, so have some fun. All right, moving on to the Groundhog, let's just do a quick update. We did have one slight adjustment. It's not slight. The motivated investors got kind of shortchanged by a crazy price, probably one of those foreign companies you were complaining about, Ken, when we were finalizing the data. So they actually ended up very close to a tie with Golden West. So we're going to call them co-champions. And second time we've had to do that in the last 5 years, but both clubs very accomplished. And congratulations, motivated investors from the Lansing area in mid-Michigan. All right. So they will be added here. Going forward, they'll have a star when they show up on the standings. Probably coming in shortly after my #1 ranking when we release the next contest. And here are the final standings. There was a little bit of turbulence here. For example, at number 8, Keith Tubbs moved up from, I think, 26th to 8th. So, Keith, you can do a little hat dance or something to celebrate with your Four Corners partners, and ending up higher than expected. But pretty much everybody else checked in at the same levels. Slight differences in some of the price lookups, thanks to some of those disruptions.
I kid Mark a lot of times about the accounting that goes on in the contest, but folks, he goes to great lengths to make sure that the accounting is as accurate as it can possibly be made. What was so interesting about this tie between the two clubs is that one of the stocks in the motivated investors portfolio is giving us 2 different closing prices on the day of the contest, and depending on which data source you use. And one of the data sources, closing prices, yields what you see on the chart here, and the other closing price is $6 or $8 ahead of Golden West. So that truly says to us that we can't make a call when it's that close, and therefore you tie them at that point. Notice that the one price, the lower price, puts these two stocks puts these two portfolios less than $2 apart. And when it's that close, anything goes. So it's a tie.
Yeah, and what's 68% between friends?
Yeah.
Good stuff. So congratulations, Motivated, and we look forward to watching you this year. And I would say 95% of the people on this list are re-engaged this year. So good luck to all of you. Just a quick reminder that we did beat the market considerably. We had a special moment. The Rhinos actually beat the Wilshire 5000. And so just a pleasure to return to some fairly significant levels in the contest. And then there's a look at the long-term trend.
Mark, maybe to please one or two of our folks in our audience, next year we'll have 4 bars on that left graph there, and we'll put Groundhog Nation, Rhinos, Wilshire 5000, and AI engines, okay?
All right, we will call them out, I guess. So here's a look at the annual performance, just to reinforce that, yeah, we did finally win after 4 years in the dumpster. So, all right, here, Ty Hughes, if you're with us, Ken, you might unmute him. Ty probably has some commentary here. What Ty has done is he's pointing out the companies that were most frequently chosen for Groundhog 2025. So is Ty with us?
I'm getting right there to it. It's not the easiest thing to search this list here. Ty is with us. And Ty, you're unmuted, Ty. So
yeah, there we go. Okay.
Tell us how you put this list together, Ty.
So I thought it would be interesting to take the high conviction, the 16 companies that were most chosen last year. And so what I did was and this is a plug for this wonderful new website that Manifest has. It's very easy now to export a list of stocks. If you have a dashboard, you can just use the print function and export it to either a comma separated value, a CSV file, or an Excel spreadsheet, and then you can grab the ticker list. And that's what I did. I took the list of the 16 stocks that Mark had listed as consensus stocks and just dropped them into a stock charts watch list. I subscribe to stock charts for pricing, And on the 2nd of February, I took that list and just ran it into this performance screen. And you can see when you sort on the right-hand column where it's sorted, that's the performance of those 16 stocks over the 1-year period ending on February 2nd. And it's pretty telling. If you draw a line there under Axos, that's about where or actually maybe even I think it was 14%. I actually, even below that, up below Green Book, that's where the Wilshire 5000 was at 14.7%. So everything below that underperformed, and everything above it outperformed. And this is the same data. This is just a Google Sheets, Google Docs spreadsheet I created. It does the same thing. It takes the price on Groundhog Day, figures the number of shares, and then takes the price at the end and just does the math. But the significant part here is that most of the stocks significantly outperformed. The ones that outperformed did better in a relative term than the ones that underperformed when you compare the two. And the net of it was, by my calculation, this could be wrong, but I calculated together that if those heavy hogs had been entered into one portfolio for Manifest, it would have been a 30% return, which is pretty spectacular considering the market had a 14.7% return. So I guess I attribute that to 3 things. I think the folks who participate in the Groundhog contest are not your average investors. I think they're, kind of like Lake Wobegon, they're all above average, and they truly are, because they take this investing pretty seriously. I think second, we have a pretty doggone good methodology, the Better Investing methodology, where we focus on growth and consistency. And then the third thing, which maybe we don't take for granted, is the Groundhog contest locks you in for 12 months. And all the studies show that people who are frequent traders tend to underperform the market. So picking good stocks and leaving them alone for a year also has some benefits. So I think those 3 things together play into why the return on the consensus, the 16 consensus stocks, was so good.
Mm-hmm. Well, fantastic. Thank you, Ty. And I think I'll hire you to put together next year's list when we release the hounds here later today or tomorrow.
You got it.
And the other thing I would point out is we will be out with this consensus list for next year. So Ty just explained to you why you might want to pay attention to it when it comes out. We'll probably cover it at next week's bull session. The consensus selections for this year.
What I might suggest, Mark, is when you get that 16 list, that the stocks you want to kind of focus on are those that you know nothing about. I mean, a lot of us know about Google, and a lot of us know about Palantir and Amazon and Microsoft. But when you see a name up there, I don't know how many of you actually understood Credo a year ago, Opera, Double Verify. When you see stocks like that, that's where you really begin your searching as to what are people seeing in this that I don't know about. And that's what makes this list so valuable, from my point of view, at least.
Yeah, Opera is basically a form of Google, or a competitor to Google, that's very, very popular amongst gamers, and there's a lot of them out there. That's what it is. All right, so let's switch gears and finish up. We've got our last 10 minutes here, Ken. Here's the Buttonwood Bulls performance. The prices were down a little bit, which raised the par. A couple companies got upgrades to some of their expectations, but everything here is pretty much still in order, and we'll just keep pressing on. Here's the actual portfolio from top to bottom, the positions that are in the portfolio. We did promise we'd talk briefly about UFP. So, Ken, would you pursue UFP today? I know you actually.
Well, I'm looking at it, and I know this sounds really simplistic, but I really like the growth for UFPT, so that doesn't disqualify it at all. And because that growth is double digit, I would be very reluctant to remove this from the portfolio even if the par approached what I could get at money market, so even if the par was approaching 3-4%, which is, I think, a pretty typical money market return in today's terms, I would be very loath to do anything with this stock until maybe that par approached zero. I like it in the portfolio. I don't want to sell it, but I don't think that 6.8% is attractive enough to keep that bottom average moving in the sweet spot. And right now, because it's green colored, it's in the sweet spot. We don't have my par up here today, but my par, I think, is somewhere around 7.7, 7.8, somewhere in that neighborhood, 8%. And so 5 above that puts it in the sweet spot, and that's 13.6 is 5 above 8 plus a little bit. So I really like the stock. The sales is great, but I don't think if you did an SSG on UFPT, you would find it anywhere near the buy zone right now. I don't think you'd find it in the sell either, but I don't think it's anywhere near the buy.
Okay, there's a couple more companies on here that he wants to aggressively attack here in the next few months, but we're going to just towel him off for right now and get him to calm down.
We're going to cool down about it, right?
In my proposal for the $140 in the fund right now are to take and maybe buy 4 shares of EXLS. And
he submitted that to me, and I agree with it 100%. It has a sales number higher than our current sales number, so it'll do a little tiny bit to move that 12 that you see at the bottom of the column, to move it up. We keep saying we think that number should be 12.5, even 13 and a half. So our long-term goal is to try to get that up in that range. We're happy with 12, but I'd be happier with 12.5 or 13. EXLS is going to move that in the right direction. And then the par that's attached to EXLS right now of better than 18% will move that 13.6 at the bottom of the column. We'll move that a little bit in the right direction as well. When you can make a buy that's going to move 2 of the most important numbers in your portfolio in the right direction, why not do it? Why not make the buy? So we have enough money to buy 4 shares. So let's buy the 4 shares, Mark.
Yeah, here's a quick look at the company. Basically, the return forecast, the projected annual return, is at a multi-year high. It has been damaged along with all the software-related companies here in the last several weeks. But we are talking about a company that is well respected in the stuff that they do. 12 or 13% growth at the top line, and that is continuing to be expected. Up straight and parallel, and a return forecast somewhere in the teens. So I find a lot to like about the company, and I think we just tack on another 4 shares. And then here's a reminder.
Mark, stay on that slide for just a moment, Mark, if you would, okay?
Sure.
Because I get the question all the time, how do you use prove? All right, and so I'm looking at this slide and I'm saying to myself, prove at 14.5, par at 19.8, 5 points higher. And I'm saying to myself, if this were my study, I might take projected average PE ratio and round it down to the nearest whole number. I might make it a 20, and I might take projected net margin and round it down also to 13 from 13.6. And that would draw the par down, and then I'd watch the arithmetic and see how close I came to the proof value. I am noticing that the operating margin in proof is sitting right there. That's a judgment call. That's part of the arithmetic. And another way to deal with the difference between par and proof would be to adjust that projected operating margin, but I would have to adjust it up a little bit to raise proof, and I'm not particularly happy about adjusting margins up to make that kind of thing happening. So I think my adjustments would come at the top side where Mark has the 2 question marks. And I think that would draw them closer together. That would be how I would massage these numbers. And that's how I use Prove on a regular basis.
Yeah, and just to whet appetites for anybody that's here with us, again, we love that you spend the time with us. We're going to make it possible for you to enter those values and substitute them on your spreadsheets here or your dashboards here pretty soon. It's a work in progress and it's basically done. We're just testing. I don't have the slide in here, but if you looked at the trend or the characteristic for operating margin, you could very easily get comfortable with 21%. Just looking at the historical trend and that characteristic. So yeah, it's in the teens.
Yeah, we're taking one step into the weeds here, folks. And if none of that made any sense to you at all, then ignore it for the moment. When you're comfortable enough with the idea that you might want to adjust some of the projections a little bit to draw these 2 numbers more closely together, then that's the time for you to begin to try to understand what we're talking about.
Right, and we will be doing workshops where we go step by step through what we just described for a couple of case studies, and we won't stop until you guys are happy. All right, here's a quick look at some of the output from Manifest right now. If you enter a company, you actually get the Chronicle. One of the other things that we find very attractive about a company like EXLS, first of all, you can see that the price has suffered. The green bars are headed down. Notice that this return forecast is near a multi-year high. So is the quality. So a lot of good stuff there. These guys are a traditional consultant / software company, and they have a lot of happy customers. Okay, so we'll go
this might be the same kind of company as Intuit or Adobe right now, which seem to be in the doghouse because of their software products that they sell to so many different customers.
Absolutely. The consultants are under a lot of pressure too. All right, so with that, just a quick reminder that we do archive all of these sessions, including our special educational sessions. We did do one of those recently with portfolio management. We called it the Jamboree. Those are available on YouTube. And you can actually just go to YouTube, search on Manifest Investing or Jamboree. You'll probably find it. If you can't find it there, we post this all under our events at Manifest Investing. Here's a quick reminder that 2 weeks from today, we'll have our award ceremony for the roundtable, and then the traditional roundtable as part of it, complete with bring your own beverages and wear your jammies. I was going to comment about my shoes, what shoes I might wear, but Ken, I'll probably have to have new shoes by then.
Yeah, you looking for blue suede, Mark? I don't know.
No, I thought he was looking for rabbit shoes.
While you have your calendars out, folks, I want to make a forward announcement that the March roundtable, which would be normally scheduled on the 31st of March, will be moving to the first Tuesday in April. That's April 7. So if you have your calendars handy, you might cross off the March 31 roundtable and rewrite it on April 7. The April roundtable will be at the regular date, which is the last Tuesday of the month.
And the reason that we're not doing the roundtable then is we're being kidnapped by Ann Manning and Matt Spielman. And the details are right there on your screen.
Yeah, we appreciate it. It'll be worth it. Just worked out yesterday that we're going to have some beginners classes. We actually are happy to be attracting some non-BI members, and a lot of members are bringing guests. So we're making an additional, not full track, but a session for beginners. Some more detail on that, but happy to see this already growing in its first iteration.
Very cool. And we had some people from, was it Nebraska, Ken, that threatened to come and join you?
They didn't threaten. They told me that they registered already. So we'll have to see if they show up. We visited a club in Nebraska, Matt, and they indicated that they were willing to make the drive. Okay.
Who is that? We'd love to have them.
Well, I'm not going to mention a name as part of the program here, but I will put a name into the Slack chat that we have. Okay.
Yeah, that sounds good.
Yeah, they're talking about Houston and then perhaps even Oklahoma City in August. So,
yep,
good stuff.
Yeah, I'm thinking about that. That's not as far as you might think. And Oklahoma City, which Houston doesn't have, has a Gordon Ramsay restaurant, which is pretty good. We can buy that for Christmas.
Oh, just what I would want to go to.
All right, so it's 40 degrees in Michigan. We're out of time, and some of you are going to owe apologies to the Groundhog on the upper left for all the bad things you said about him. And there is that Clydesdale teaching an eagle how to fly on the lower right. That actually is
this you teaching your grandson about up, straight, and parallel, Mark, in the middle here?
It certainly is. That is our grandson, Lincoln.
Okay.
That is our grandson, Lincoln. And I'm proud to say that he owns Apple from that day. So he still owns Apple from that day. So, and yeah, for those fans of our Delics that are out there, Kim and I are watching very closely. One of the companies that has expressed interest in our Delics had a meeting last night. We don't know the results of it yet, unless you have any hot news off the press, Kim.
No, I'm afraid I do not.
Been pretty quiet, but they were trying to get financing in order to possibly make an offer, and it sounds like they were making progress. So with that, please send us any suggestions or questions that you have. We appreciate you spending your time with us. Hopefully we showed you a few things which might trigger some interest. Try some of the stuff that we tinkered with here today. Have some fun. And let us know what's on your mind. Anything else, Ken?
No. Not. I've really talked a lot today, so no. Just wishing everybody well, and we'll see you next Tuesday.
All right. No abuse for if I end up in first place tonight in the Groundhog. I don't want to hear any abuse. All right. Take care, everybody.